Hello and welcome to another episode of Stock Talk. Today, we are combining our coverage of Palantir Technologies and Peloton Interactive. If you've been following our show, then you know that this is now the fourth time we're covering PLTR, and the second time for PTON. These two companies, while in completely different industries, share one major thing in common. They are two companies that have been around for several years, but have only recently IPO'd and have had a lot of debate over their long-term prospects. So, you might be wondering, do we still think these stocks are a buy, or is it time to sell? Well, stay tuned and find out. But before anything else, be sure to smash that like button and subscribe to my channel below to stay in the know. Now, for those of you just tuning in, Palantir Technologies went public just in September of 2020, but the company has been around since 2003. Since then, shares are up a whopping 167%. PLTR's rise to the headlines can be traced back to this year's meme stock frenzy and the famed Cathie Wood's ARK ETF's investment in the company. The company is widely known for providing big data analytics to US intelligence agencies and the Department of Defense. In fact, it was rated in 2014 by Forbes as one of Silicon Valley's most valuable tech companies. Despite being part of the original meme stock craze, we believe PLTR to be a strong long-term value play. From its share price of $19 during our last episode to its current price of $25, it has already gone up over 20%. Compare this to the $39 high in January and its 52-week high of $52. But don't fret. Earlier this year, we saw a rotation away from growth stock and into value stocks, and PLTR is a large cap growth stock. Given its current price, we still feel comfortable saying it's trading at a relative discount. However, if you recall from our last episode, not everyone agrees. Some analysts have taken issue with what they consider a rich valuation, and one analyst even cited the fact that it generates most of its revenue from existing customers as an inherent risk to long-term sustainability. But we were quick to blow a hole through that argument. Well, sometimes it's important to step outside the valuation metrics and properly analyze its competitive space. The fact it generates most of its revenue from existing customers can just as easily be proof that Palantir excels at client retention. After all, revenue per client did increase from $5.9 million to $7 million year over year as of the last episode. This was undoubtedly fueled by the 248 increase in billion. Talk about cash flow, right? And don't forget, on its 10K, Palantir revealed remaining deal values of $2.8 billion and is expecting up to $4 billion in revenue by 2025. On top of that, since the beginning of the year, Palantir has been extending client relationships with new contracts and partnerships. In fact, we have quite a few new updates on this front for you. Be sure to stay tuned and find out. And if you like what you're hearing so far, be sure to click like and subscribe. Palantir's competitive advantage lies in its integrated approach to an entire enterprise, and it allows clients to keep legacy software to build off of. As a result, it has few direct competitors. Since just our last video, Palantir has not shied away from making big moves. At the end of May, Palantir announced that it was awarded a $111 million contract by the United States Special Operations Command, known as USACOM, to improve its system's situational awareness on the battlefield, and upon being awarded this contract, $52.5 million was distributed immediately. Talk about cash flow. Since then, a lot has been happening in June, over just these past few weeks. On the 10th, the CDC renewed its contract with Palantir for $7.4 million, so Palantir can continue to help them continue to improve their ability to collect epidemiological, surveillance, and lab data so they can better make decisions about outbreaks. In a post-COVID-19 world, this is as crucial as it is innovative. And just last week, PLTR was added to the Russell 3000 Index. On the 15th, Origin Materials, a leading carbon-negative materials company, announced a strategic alliance with Palantir. Origin will use the Palantir Foundry in order to understand and assess carbon-intensive supply chains on a global scale to innovate ways to decarbonize them. This is at least a $1 trillion market. Then, just a couple days later, Amazon awarded Palantir with the 2021 Global Amazon Web Services Partner Network Public Sector Partner. What a mouthful. So, what is this even for? What does this even mean? It means Palantir was able to leverage its technology It means Palantir was able to leverage its technology along with the Amazon cloud to integrate, harmonize, and analyze COVID-19 data for the National Institutes of Health. And now, just this week, I can barely catch my breath here, Palantir announced that it was granted a whopping $18.4 million contract from the FAA to provide a data analytics tool for aviation safety based again on the Palantir Foundry. And what will its main project be? None other than the Boeing 737 MAX. No doubt in my mind that this connection to something so prevalent in the news will only help boost Palantir's profile and put its strengths to the test. Now, what do you think about all these developments? They seem pretty positive, right? Nothing can go wrong. Or can it? Let us know your thoughts in the comments below. But aside from all this good news, how's the stock doing? According to Morgan Stanley analyst Keith Wise, PLTR is currently trading at 22 times the 2022 sale estimates, and growth potential has already been priced in. The chart itself just shows a neutral pattern. But where Morgan Stanley sees an underweight rating, Goldman Sachs sees a buy rating. Palantir has met its past earnings estimate and exceeded its past two. It's still too new a stock to rely on metrics alone. We need to contextualize the opportunity before us. And with that thought, we take you to Peloton Interactive, ticker symbol PTON. For those of you who remember from our last episode, Peloton was established as an interactive, video-enabled fitness bike company in 2012 and has been popular with users ever since. Bikes can run up to $3,000 and treadmills can reach almost $5,000. It has 95 showrooms, 2 studios, and is present in the US, the UK, Germany, Canada, and plans to enter the Australian market this year. Not only that, Peloton has had a successful history of buying out its competitors. It IPO'd just recently in 2019, resulting in auspicious timing for the COVID-19 lockdowns. But it has not been without its issues. Peloton has faced some controversy and recalls following 39 accidents, including one child's death related to its treadmill. Despite all that, the pandemic stock price surge, fueled by the lockdowns, was able to overshadow those unfortunate incidents, until maybe now. Having peaked in December of 2020, Peloton stock has decreased through April of 2021, and in an effort to get ahead of the game, Peloton has voluntarily issued a recall on its affected products. A move like that should help to reassure investors of longer-term prospects and that Peloton is not rushing to cut corners for a quick buck. They do have one investor at their side though, none other than Cathie Wood. After the price decrease, Cathie has been buying up Peloton stock, indicating expectations of a rebound down the road. Forbes also sees great potential. In a recent article, it reports that the economics of owning a Peloton compare favorably to gym memberships and spin classes. The market seems to agree. Users are able to video chat with workout partners and challenge each other from the comfort of their own homes. And despite the relatively depressed stock price, it is still about 5 times higher since the start of the COVID lockdowns in March of 2020. It has beat its past 4 earnings estimates, and revenue is up exponentially since 2017, starting at $218.6 million to its current levels of $1.83 billion. Earnings are still negative, but they are improving. The average analyst price targets us at $130, as of just last month, with 26 out of 28 analysts recommending a buy or a hold. Forbes' own proprietary software expects a 64% change of a price increase over the next several months, with the expectation that sales grow 2.4 times over the next 4 years and profitability to continue to improve past 2022. This doesn't mean Peloton products are without risks, though. Treadmill customers received a nasty surprise recently to learn that they were automatically forced into a $39 a month subscription after a software update was installed to deal with the safety issues we mentioned earlier. Some angry customers are going public on social media and calling it akin to theft and ransomware. And a recent study by McAfee shows that hackers can gain access to Peloton cameras and microphones and can spoof apps to try to get users' login credentials. Yet, despite these risks, in a recent survey, 77% of users noted they feel happier and 65% noted their mental health has improved. Clearly, customers are not ignoring the benefits. But what do you think? Is it too soon to call? Are you ready to buy, or do you plan to wait for post-COVID life to really settle in before judging on its viability as a company? Leave us your thoughts in the comments below. Well, that's it for today, folks. There you have it. 2 companies, Palantir and Peloton. Both are new to the stock market. Both are being closely watched and debated. Both are favored by Cathie Wood. We still think these are good long-term plays when you price in their opportunity and analyze their competitive space. We're talking about companies that are ahead of the curve here, people. Nevertheless, we will continue to watch these moves for you and keep you updated. So remember, if you like what you saw, be sure to click like and subscribe, and we'll see you next time. Thanks for watching.